Good afternoon, everyone. We've done the dramatic catwalk scene, so we can get started. We're going to play a little game on this panel, just to, spice things up a bit. If any of you says educate, you will have to tell us your worst fears about crypto and the business. No more education, okay?
It's a bad word.
It's a bad word. It's a bad word. I'd like to encourage you guys to send in questions because, we need your help to get this going because they can't say educate. Let's get cracking. I'd like to ask the panel to introduce yourselves briefly. My name is Szalay. I'm currencies correspondent for the FT. And I also would like to know a one-word answer to this question. Does DeFi need institutional adoption?
Maybe.
That's a good answer, yeah? Would you like to introduce yourself as well?
My name is Lorien, Gabel. I'm one of the co-founders of a company called Figment. We are a Canadian-based company that provides staking infrastructure to institutions, which we could talk about what staking is, but it's basically a form of yield generated from crypto assets.
Thank you.
So I'm Stani. I'm the founder and CEO of AAVE, and AAVE is a team that built the AAVE protocol, which is one of the leading DeFi protocols deployed in multiple networks in Ethereum, Arbitrum, Optimism, Polygon, and Avalanche, and some other ones. And I will say, DeFi needs institutions because there's a lot of institutions here, and I don't want to get kicked out. So,
so that's a forced yes.
You just said no, and we could all go drinking now.
Great, thank you.
So I say yes. Henrik, co-founder of Finoa, is a Berlin-based crypto custodian serving institutional investors, ranging from venture capital, hedge fund, asset managers, family office, regulated under German BaFin, and absolutely into institutional adoption.
So I'm Jonathan Dakin. I'm the head of sales for Fireblocks for EMEA. I haven't set anything up myself, so I'm just the head of sales, so I'm thinking about this. But from an institutional point of view, DeFi definitely needs institutional adoption.
Would you like to tell us why? Well, because we're going to get to that point, so we'll start with you, if that's okay, Jonathan. Why do you think that?
So, Fireblocks is a security infrastructure company for digital assets. I've been with the company now for 3.5 years, and at the beginning of this, we were looking at it going, what's really going to grow this sector? And it will be the adoption of digital assets by a wider market, by institutions, and we've really seen that happen, right? And I think we've got 1,000 customers, and about 20–25% of those are really working with DeFi at the moment, right? So it's been a huge growth in adoption from really nothing. And we've seen in my 3.5 years with the company that sooner or later, the disruptors in every space turn up here. And we'll see that with the banks and the major financial institutions. But maybe we should define what an institution is.
Well, before we do that, and before we open that particular can of worms, let's define what DeFi is. And I've been reliably told that the man to ask here is Stani.
Essentially at least for me, what DeFi is, it's a kind of like a permissionless ecosystem where anyone can pretty much interact with the software architecture, and that means that many of these applications, financial applications, are running on the blockchain, and anyone can interact. That can be anyone, any part of the world, regardless what kind of background it is, whether it's a retail person or institution. And it's an ecosystem that is based on open source technology and open communities, meaning that anyone can actually contribute to those code bases, improve the code base, and also govern that protocol as a community, making different kinds of improvements or proposals how to safeguard this valuable infrastructure. And one of the important things for me that what we have in DeFi is the transparency. So essentially, all transactioning is auditable by anyone, any single second, meaning that we have a financial ecosystem where anyone can actually even create better risk mitigation tools and calculate and quantify all this like systemic risk. And one important thing with this interactioning is that you have the choice to interact directly with the protocols in a so-called non-custodial fashion. So you can actually keep the custody for yourself, interact and hold your keys, or you can choose a service provider that can make that interactioning happen for you and hold the keys and provide that as value-added service. And essentially, I see DeFi as software that is governed by the community, and the community is all the stakeholders that are the users or who cares about the protocol.
That's very useful, thank you. And I'll put this question to the panel, so please, any of you come in on this. I've heard about the decentralization illusion, specifically from the BIS, but don't worry if you don't know who they are, they're not relevant. Can you tell us about what you understand as true decentralized finance, and what are the kind of examples of ones that just masquerade as decentralized but are actually quite centralized?
So I would think of decentralization as it's on a spectrum. So it's not a 1 or a 0. And I think that very often, if you look at a specific protocol, they will start off relatively centralized with a small set of token owners, for example, or participates in a community, and the successful ones will slowly expand. And that will include from just the people who hold the value to also governance, and the amount of people who participate in governance. So I think it's a difficult question. I guess some people have some very sort of hard lines in the sand about what qualifies as decentralized or not, but I don't think you can look at it that way. I think it really is a spectrum, and there are some communities that are obviously fully decentralized, something like Ethereum, and then you'll see a new protocol launch, and there'll be, a couple of very large VC investors, there'll be a community of hundreds, and then if they're successful, that'll grow. And if it's not, then it'll stay centralized, and you'll know it when you see it to some extent. But I don't think there's like a hard and fast definition.
But does it matter? I mean, we talk about DeFi as the new, big, exciting space that's going to solve all the problems we have in the sort of old centralized world. So shouldn't it matter whether it's actually really decentralized or not?
It's only if you see if there's a lot of problems from centralization. Like I personally view that there's a huge number of negative externalities due to over-centralization, whether that's culturally or politically or economically or financial institutions. Like we're clearly in a state like, just take Google, doing things with your data, making billions of dollars, you don't really know what's going on with your data, or you read Twitter for 5 minutes, you get angry. That's kind of weird. That's because there's only a couple social platforms, or you're a developer and you get kicked off a platform after you've helped them build up that business, which happened with Facebook developers. So I think that everyone, leaving aside the pure economics of it all, feels some discomfort with our current tech stack, right? Like something's not right, doesn't matter where you live or how old you are, et cetera. Like there's something wrong with our public, mostly private tech stack. And so I think that what these technologies are is really a counterbalance to what's happened over the last decade, with a few very large gatekeepers controlling a huge amount of the internet, basically. And so I think if you view this set of technologies as generally being a counterbalance, I don't think anyone here is an anarchist. Well, maybe you're German, you might be an anarchist, but I don't think the rest of us are anarchists here. We all have businesses we're running.
We want to hear about that.
Yeah, that's much more exciting. So, but no, we're not. I mean, we're all building businesses here, but I think that if you believe there are a whole bunch of set of negative externalities due to the centralization, then this can be a counterbalance to that.
Thank you.
Yeah, I mean, Lorien, both of our businesses are some examples of, kind of the pathway that we take as an industry, right? I think you don't jump straight into only decentralization. I mean, that was the beginning, but then you saw, especially from an institutional perspective, also a lot of need. Hey, I don't want to manage my own keys. I want some service provider helping me with that. I maybe can't run my own node. I want to work with a staking provider helping me with that. But at the same time, what we see as well is how the landscape becomes more diverse, how we see as well a lot of our customers starting, for example, spinning up their own validators, spinning up their own nodes to kind of help with the decentralization. But then again, you could also say, hey, they all run it in AWS, and how decentralized is that, right? So I think there's still a lot of stuff that we have to work on. But I mean, we are on a pathway, right? And it's the opportunity that we have. The technology can do it. It shows how it's possible. And I think that's how we take step by step. And I'm taking ourselves as an example. One could say, hey, crypto is kind of cut out all the intermediaries, and we are indeed a centralized custodian that is helping institutions to access crypto again. So somehow we are an intermediary in a sense as well. But in my point of view, and I think I speak for our customers as well, an important pillar to help them access different products, different yield generation opportunities. So we grow with the ecosystem, but it's not black and white.
Thank you. And Jonathan, just to sort of loop back to your point about what's institution and what's not institutional, could you tell us a bit about whether you think DeFi is being driven by actual institutional adoption, or is it a retail market, just like crypto used to be? I mean, by Bitcoin, sorry, as a sort of broader market.
I think it's a bit of both, right? You know, when I talk to people generally about this space, the word that comes up all the time is just interesting, right? You know, it's just a very interesting space. So you can look at it from an analyst point of view that, you know, this is going to open finance up to everybody, or you can centralize the whole thing and say this is going to end up with JP Morgan, you know, HSBC, and you know, those sort of organizations. But, you know, for me, I think it's just the rate of innovation that's really interesting for this. So, you know, if you look at digital assets themselves, it's another asset class that's not going to go away, right? And you're beginning to see, you know, State Street, you're beginning to see BNY, you're beginning to see all these people start to happen. They're the disruptors in this space. But then, you know, you've got organizations like these that are sort of saying, look, okay, I'm going to have a KYC pool, you know, like AAVE are doing, and therefore it opens the door for the institutions to, you know, start using trusted infrastructure, and, you know, they'll be doing things in a centralized or a decentralized way, but it's just innovation, and it's an asset class that's not going away. And that's what makes it really interesting, I think. It's neither anarchy or centralization, it's something completely new. And that's what I find really interesting about this space. It's, you know, anybody that sort of comes into this, whether you're an institution looking to take advantage or an asset manager or just in your career, it's something that nobody's done before. Well, at least for a very long time.
Thank you. I guess one of the questions that I wanted to touch on later, but we'll just tackle it now, is what role do you see in the DeFi world for institutions such as JP Morgan or HSBC, so the large banks and financial market infrastructure players today? What will they bring to the party, Stani?
I think there's like a lot of value added because they have a lot of customer base. So traditionally, when you look at financial institutions and service providers, there's so-called modes, right? So you have some technology, but then you have like a lot of user base and clients and services that you already kind of like have established. So I think there's a lot of liquidity there that could be obtained and used in decentralized finance. And essentially, decentralized finance is kind of like a one value network where things can move very quickly and innovation can happen quite in a high rate. As Jonathan mentioned about the rate of innovation, that's been one of the most exciting thing about the space, because when you have an open ecosystem like DeFi is, it means that anyone can pretty much take the AAVE code, improve it a bit, and redeploy it, create a new community, or just contribute directly to the AAVE protocol, and you have innovation there. And when you have this kind of like an open culture, things are moving fast, but they become very efficient for the end users. And I think it's kind of like goes back to the question of whether things should be decentralized and whether it matters, because essentially, like the financial infrastructure, it's very valuable infrastructure. It's pretty much like everyone will be using DeFi. Well, if like my dreams will come true, like the same way as we use HTTPS or IP protocols without knowing them necessarily that we are using. And if everyone will be using DeFi, I think the best way to maybe govern this infrastructure is to govern together instead of having, let's say, centralized companies having that data set, but it's actually available to anyone. And one beautiful thing that I see happening in decentralized governance is that, especially in the AAVE governance, is that you need to have very wide consensus on the decision making, because otherwise you kind of like create that minority, and the minority can always fork that code and create a new community. And this is something you don't have in traditional finance, because obviously it's very difficult to fork a bank and all the clients and all that like IP and everything. So this actually kind of like one way creates an infrastructure that can be governed together, and institutions could be very good governance as well. So it's not about kind of like, you know, the common people, their funds and institutions, you know, setting them kind of like opposite each other, but it's like how you can govern together, and I think there's where the value could come.
And I think it'll also be there's going to be an innovator's dilemma, I think, for many of these institutions. So I don't know if it'll be life or death in the next 5 years, but if you look at the trend of open source software, and what I think everyone up here believes is that protocols will win out over platforms over time, that there's going to be a decision point whether you're going to put part of your businesses out of business or adopt this, because it's going to happen inevitably. Like the move to open source software is just about complete. We've seen the growth of platforms. The original internet was based on protocols, so like HTTPS or email, SMTP were totally open. There's been a centralizing force, which have been these large platforms like the social networking platforms. And I think what you're going to start to see now is these protocols, which we're all involved with, are going to start to replace those platforms. So if you see your company as a platform, then I think you really have to look at like the multi-decade risks to that business and figure out a way not to sort of suffer from that innovator's dilemma.
I also think that the DAOs, they will create a lot of businesses at the same time because they create a lot of opportunities. And that's kind of like, I see the same way that you kind of like, it's going to be difficult for platforms, but there's going to be more and more service providers. And this is where institutions as service providers could help, and they have value.
So you guys are saying that the sort of institutions will run the platforms and then they'll need service providers, or that we won't have platforms?
We will have protocols.
We have protocols. There's a thesis that the protocols will replace the platforms. So you won't need a dominant platform like Facebook or a few dominant, very large financial institutions, which essentially, in conjunction with central banks, control everything. That over time, protocols, because they're decentralized, people own it, they have an interest in those protocols rather than a few people, that they'll over time will eat away, just like open software has eaten away at proprietary software over the last 3 decades.
And you reckon that's actually going to do away with central banks, with JP Morgan, Facebook, you know, all these guys?
I mean, it'll be slow and it seems inconceivable over time, but these things happen very slow and then they tend to happen all at once.
So to this point, is DeFi a rebellion, if you like, against the financial system or big tech?
Yes, in some extent. Look, so we have, unfortunately, I'm like the oldest person in my company, which is embarrassing, and so we have a bunch of 20-year-old and 30-year-olds who have joined from an engineering perspective.
Lorien said he's going to sing later, so he's young at heart.
They'll be, right. You run quickly. So, and how people get into Web3, like it's a wonderful term because it's very poorly defined, right? Like Web3 can mean a lot of things, and it's useful for recruiting. But people come at this place. If you talk to, like, if you go to one of these conferences, and there'll be a whole section on NFTs. I think there's one on NFTs coming up, and it's like a cultural movement. Like if you talk to artists who are 18 or 19 or 20, like they don't give a shit about being in a big gallery, right? There's something about NFT. They don't need that intermediary. They don't need a gatekeeper keeping 50%. And so that's just one example of it being a cultural movement. It could be political, it could be financial, it could be historical and economic or artistic. But I really think that there's a movement among a younger generation to take back some control from the failures of essentially institutional failure at scale, which I think we're kind of seeing all around the place. So I'd posit that it's a long-term trend that's not going to change. And as old people like me die off, boomers die off, then this is going to replace it.
But I resonate because, like, for example, like for me, like when I look at traditional financial services, there's just absolutely nothing there for me. You know, I want volatility. I want to ape into things that, you know, might melt tomorrow, or basically just have this like composability.
You want to take risk.
I want to take risk, but also I want to invest things that are fascinating to me, like the technological point of view. And doing that in traditional systems is just like very clunky, but also super boring. Like I think like that's the issue. Like then, kind of like, and the reason DeFi and all this like NFT Web3 ecosystem is moving fast is because there's just room to innovate, and nobody has been caring about Web3 for a while, for a few years. So this innovation has had like its own kind of like a space to grow. And at the same time, when you look at more like traditional finance, it's just, there isn't like much of you can innovate. And most of the kind of like innovation happens in bigger organizations, but in R&D departments, and then it's very difficult to scale. I mean, fintech is amazing. There's a lot of progress in fintech, but it's like engineering on the front end of the whole financial system, where DeFi is like re-engineering the back end of the system.
You just didn't fancy working in Canary Wharf, right? Okay, so what's been driving this extreme growth in DeFi and volumes in the DeFi space? I think it'd be really interesting to touch on that, and maybe we can introduce the concept of staking at this point.
Sure. So, all right. So, what is staking? I don't know. How many people here think they know what staking is?
They're all degens. They're all degens.
They're the people that work for us. So no. So I use two, like, it's perhaps like overly simplistic buckets for thinking about yield generated with crypto assets. And again, will shortly be too simplistic. But if you think about, there's a whole set. You have these crypto assets, and there's an opportunity. You can custody them. And then what do you do with those assets? So some of them are able to generate a yield effectively with them. And then there's two big buckets that I sort of view the world at. One is a whole set of activities like lending, yield farming, liquidity provision. So you can actually be a liquidity provider for a decentralized exchange. And those have an attendant set of risks and rewards. You could have smart contract risk, you could have counterparty risk, et cetera. And so in theory, over time, those should be riskier but a higher yield. And then we put into what we do at Figment is in our bucket, which is protocol staking, which is essentially becoming a version of a miner in Bitcoin language. So you participate in the protocol, you stake directly to the protocol, you govern the protocol, and therefore when people use that protocol, you generate rewards or yield from that activity, from actually participating in the protocol. So, and in theory, that should be passively, it's passive, a little more stable and less risky. And so over time, you'll start to see, I've sort of done two big buckets, but over time, you should see a yield curve that's very clear, has a set of risk rewards from these crypto assets. So that's how, so I define staking that. Staking is often, it's a poorly defined term, but I think that's one useful framework for just understanding the activities that generate this return for holding crypto assets.
So do you guys want to maybe touch on whether that had anything to do with the surge in volumes in DeFi?
Well, I mean, institutional participation definitely increased the volume dramatically. I mean, we saw that with our, like, say, average wallet sizes that we were serving our customers with from a custody perspective. And then we saw also how this entire staking space just exploded over the last 18 months. I mean,
macro conditions, zero, negative interest rates, obviously,
exactly.
It's going to be a big driver of that. Right?
We touch regulation, I guess, non-regulated business, so for institutions, easy to go in and participate. And then really creating incredibly interesting yield rates. And by now we have, out of our proof of stake protocols that we support and assets that we custody, we have 85% stake rates. That just looked very different at the beginning. They were able to stake, but they just didn't because there were some questions about taxation or do I really want to do that? They didn't understand the risks. But with more, let's say, stable custody products in the market, more stable staking products in the market, the interest became much higher, and we've seen that really, let's say, the delegation rate just explode. And that obviously helped the overall volume in the market. Now you can still, again, terminology argue is staking really DeFi? I mean, it's yield generation in a sense, right? That if you fold yield generation on a DeFi, then staking, I would put that under it as well. And then maybe for more DeFi access, especially for us, for example, as a custodian, it's not so easy to provide that because, again, I said in the beginning, we are regulated. It's not so easy to bring that to the customer at the moment because it's unclear what the regulatory status is of liquidity pool, of decentralized lending, etc. So at least for the German regulator, they're not, I mean, they kind of understand now what staking is, and they still, accept that is unregulated. I personally think that's going to change, but let's see how that goes. But if it comes to decentralized lending, you just lose them while you explain it to them. I'm not using the word, but we are trying to really help them understand. Yeah?
Very nicely dodged. I like it. Any more thoughts?
No, look, the way I see this is, you have, risk was mentioned there, right, and regulation. It's, the thing that I think has really driven adoption is, having the infrastructure to do this stuff, right, more safely. So, if you look at Fireblocks, we've got, $200 billion worth of assets going across our rails in any month, right? 20-25% of that is now either staked or in DeFi. And that's been driven by people sort of saying, right, we want security around this, we want infrastructure, we want stuff we can trust, and that will eventually drive not only you and I sort of dealing with this stuff because we feel safe about it, but also the institutions and the regulators coming out and saying, okay, we can trust this stuff because there is infrastructure around it that we can adopt and we know works and will help this stuff scale in a safe way. And we see that all the time, right? Adoption is really supercharged by the things that aren't in the financial system at the moment. I can't earn much in the way of interest on my savings, but if I'm getting involved in these things, I'm getting money for it. Yes, there's risk, but essentially, it's interesting. You're not sort of phoning up your bank and going, oh, I'm on a negative interest rate.
What sort of, where does the yield come from? See, this is the big question that I've been wanting to understand for a long time, because just a couple of years ago, maybe 3 years ago, one of the big criticisms about Bitcoin was that you can't value it, it doesn't have yield, blah, blah, it's just a thing. So where does yield come from?
So I'll let him answer how the DeFi yields are generated. The staking yields, you can think of it as if there's been a big transition from proof of work, which you're probably familiar with, which is what Bitcoin runs on. I love this isn't a negative statement about Bitcoin. Don't throw things at me. I own Bitcoin. It's great, but you have these miners run big data centers, consume a lot of electricity, and has some scalability concerns. So that's proof of work. And over the last 3 years, there's been a migration of blockchains, of protocols, networks, I use that word interchangeably, to proof of stake. And if you know one thing about what the heck the difference is, well, there's a couple small things. Proof of stake uses less electricity. It should be more scalable in theory. But most important is it basically brings the function of the token holder with the right but not the obligation to participate in running the protocol. So it's as if you as a Visa credit card holder own part of Visa, and actually when your card was helping process transactions. So you have the ability to, so if you hold Solana and you're staking it and there's an NFT platform on Solana, there's going to be a set of transaction fees generated and usage generated by people who are buying and selling art, et cetera. And then you as a Solana token holder can actually govern and participate in that ecosystem. So it's really pushing out the value of the people running the network to the actual people who hold that value. So that's, I think, so in Bitcoin you have two big audiences. You have the token holders and the miners. They're separate, usually interests are aligned, but not always. And what proof of stake has done has brought that together. So if you're governing and running and processing transactions as a token holder, then you share in the rewards generated.
So the yield comes from, you basically get paid for someone borrowing your asset to do something with it.
Well, doing something with that protocol. So they have to be used for something in the real world, like running an NFT platform, for example, and buying and selling art, and then there'll be transaction fees generated from that, and the people who are staking or running the protocol share in those rewards generated.
It's like a sort of reverse short selling, isn't it?
Maybe. Not so sure. Yes, in a way.
We'll think about that.
Yeah, we'll think about that. And then there's a whole set of probably more fun and interesting set of activities that generate yield around the other bucket of DeFi activities.
Yeah, also, for example, in AAVE protocol, the yield comes from pretty much like when you supply liquidity into the different pools or so-called reserves, what happens is that there's a pool of liquidity and you supply there, and the interest is divided to all of the suppliers. But part of that liquidity is consumed by the users. So you deposit one asset and then you borrow another one out of the system. So basically, these borrowers are repaying interest into the protocol, and that interest is then distributed amongst the suppliers. And I think that's very clear how it works in terms of the technicalities. What's fascinating is then where what is the kind of a borrowing use case? So where the demand comes from? So essentially, with many of these cryptographic assets, we see that we have users that are in a kind of a long-term position with those assets, and they necessarily don't want to sell those assets because then you cause a liquidation event, meaning that you don't have a long position anymore. So what you do is so-called kind of an equity release. So let's say you put 100,000 worth of Ethereum into AAVE and borrow 50,000 USD worth of stable coins, and then you finance some particular goal that you have in mind. This goal can be anything, to be honest, and because the system is decentralized, there's over 100 access points into the AAVE protocol, including wallets, including custodials, Fireblocks, and everyone that provides the accessibility. It's hard to kind of like imagine exactly the data. I mean, the data is all available there, but actually what the users are doing afterwards. So we see the on-chain activity, and pretty much in some cases it's some other investment opportunity or leverage opportunity. But for me, the most fascinating finance goals happen in real life. So when you borrow stable coins to convert them into fiat currencies, such as, for example, dollar, and you want to finance, for example, buying a car, mortgage, or even buy your kids' tuition. And this is actually that is happening. I've been talking to many people in our community. One example is that one of the community members basically bought a house without selling their cryptographic assets. And why this is important is because today cryptographic assets, we see as this community, for example, we see Bitcoin, Ethereum, we understand now governance tokens, but over a period of time, pretty much anything could have a representation in a cryptographic value. That can be this property here. It can be different kinds of hardware. It can be even buildings and houses and so forth. So this is why the AAVE protocol is important, kind of like a tool to unlock that liquidity and use it so it doesn't sit in the actual value object itself.
But does this also work if the market's going down?
Yeah, when the market goes down, what happens is that your value of your collateral gets reduced. So what the users are actually doing, usually they are supplying more collateral. Or if something happens that you can actually supply collateral, in overall, there's like, across the whole protocol, when we look at the collateralization, there's like 3 or 3.5, almost 4 times of collateralization. So actually that the users that are having that like a very narrow leverage is quite narrow in that sense, but most of the users are pretty much like over collateralizing quite substantially. But if there is a liquidation, it means that essentially there is so-called decentralized liquidator network, meaning that anyone can actually come and liquidate that position, taking the replacing the debt, taking the collateral, reselling it, and then the protocol is solvent again. And why this is important actually is that when we look at cryptographic assets, they're very, very volatile. And we had cases in decentralized finance where the asset valuations dropped by 50 or even 60% in some market conditions. Black Thursday is one of those days, if anyone here is deep down the DeFi rabbit hole and remembers. And what's fascinating is that the AAVE protocol, for example, was resilient on this market condition drop. And one of the exciting parts is because the network of liquidation was open to keep the system solvent. And I think that's something I'm very proud of DeFi.
Do you think these systems are more resilient or more anti-fragile than traditional financials over time, since there's much more experimentation, you don't have centralized points of failure?
Yeah, I think there's a lot of opportunities to create a strong system, and I think in the current shape it is because of the incentives. So if you liquidate positions, you get incentives, and you have competition on those incentives. So you are trying to liquidate on the best market conditions, but also what's new as a financial paradigm in DeFi is that you see everything. So you see all that risk exposure, you see how much there is debt in the AAVE protocol, how much there is DAI stablecoin minted, which asset is backed by what. And it's not just one protocol exactly, it's the whole DeFi ecosystem that you can actually quantify. And when you go back in time to 2008 and think about all the kind of like so-called toxic assets and how they were issued and which bank had what kind of exposure against each other, it wasn't that easy to quantify. But in DeFi, any part of the world can actually quantify it every single second and audit what's going on there. And I think this is the way to create not just kind of like a fair, better finance, but also more resilient finance.
Thank you. We have no time to tackle these questions, but we'll try anyway. DeFi killer use case that my granny would understand. Anyone has a quick one?
We need to know a little bit more about your grandmother. So
She's totally into DeFi.
She go to Vegas or did
Wrong
she-
investment horizon.
She's into DeFi, all that stuff.
Probably you can make money from it. I just thought that would be it.
That is a good one. To follow up on that, what yield level would you get suspicious? Like, what should if someone calls my granny and says 1,000%, should she go for it?
Do you think so? No.
So actually, it's kind of the financial inclusion thing's quite interesting because it is. It's it's kind of we're all sitting here in a room, and
We are including my granny.
yeah, you're including your granny, but actually, a lot of this is about ways of making money. Other than buying a house in this country, it's very difficult to earn an interest and be in control of your finances, and I think this helps.
What's the biggest risk? One sentence from everyone, and then we'll shuffle off. The biggest risk to DeFi?
So I think I have this spiel about, I don't have much time, but about regulation. So, I think in the West, we're generally limping forward toward a stable and fairly workable regulatory environment. 2 steps forward, 1 step forward, 1 step back. We're, based in North America and the U.S. and I have this thing about the Americans that they'll do what's the Winston Churchill? They'll do the right things only after they've tried everything else. And I think that's kind of like how we're moving forward on the regulatory front. So I think that in 3 to 5 years, we'll get somewhere that's not perfect. It'd be great if someone had a theory of the case and saw it as competitive technology. But that institutions, individuals will be able to operate in this framework. But I think that there are some dangers in specific institutions sort of taking, you have a specific politician or government office that sees this as a threat rather than an opportunity. And so I think that that's like, if you're in the space, you have to get comfort, you have to get a comfort level, and I think that's obviously still like a relevant issue for many institutions, although less and less over time, but I think that's one of the big risks.
Regulation, thank you. Stani?
I'll say low yields, and hear me out, because in one way, DeFi kind of like is bringing a lot of those opportunities and financial inclusion, because like in regarding our protocol, for example, the idea is that any part of the world you can have the same opportunity, the same yield. But also if you think about like finance and going back like historically, being able to give your funds into a, for example, asset manager and kind of like attract that additional capital, I think it's very important. And the innovation that is in DeFi, and of course, like by low yields, I mean that we have a financial ecosystem that doesn't bring additional value to the users. Is something that I will be concerned, because the idea of finance is actually not to make the big guys rich. It's just like to distribute that wealth to everyone. So I think that's my concern.
Thank you.
Well, not to repeat, but I guess I see it with Lorien as well on the compliance side. I mean, the European Union just 2 weeks ago was about to run a proof of work ban, right? These days they're about to discuss if they should ban unhosted wallets, so everything that is not with a custodian, which is MetaMask, which is Ledger, whatever, self-hosted keys. So misunderstanding on that side is a massive risk, because actually I think they should see the opportunity, the transparency, everything we discussed here, as actually a better financial system, more stable financial system, but the misunderstanding leads to some very interesting discussions. So I'm about always every week at the moment, I'm sending emails to all parliament members of the European Commission to kind of try to avoid the next vote, and that gets a bit stressful now.
Thank you. Jonathan?
I think it's just about trust, right? It's about regulation, it's about security, it's about yields, being able to deliver what we say we're going to deliver and keep doing that. I don't think there's much trust in the current financial system, and we have to do a better job.
And on that note, we'll go, because we don't want to do the next discussion as well. Thank you so much for the panelists. Please say a big hand for them. Thank you.